Welcome back. It is time now for the Word on Wall Street. Top investors watching your money. Joining me now is Key Advisors Wealth Management CEO Eddie Ghabour. Also with us is Kenny Polcari this morning. Eddie, thank you for joining the conversation. Welcome to you. We got a market that is strong going into the final full trading week of 2025. Can you believe Christmas Eve is next week? The Dow Industrials right now up 212. The Nasdaq's up 114. And we are wrapping up what has been a big year for the economy. The Federal Reserve delivering 3 straight rate cuts. Gold prices hitting record highs. Several economic hiccups also happening, including the longest government shutdown in history. One theme, of course, stood out. Big tech and AI drove markets to new record highs. Despite growing concerns about valuations, investors also watching 2 major market movers, the Supreme Court decision on tariffs, which will happen imminently, and the president's choice for the next chairman of the Federal Reserve. The president said he's leaning toward Kevin Warsh or Kevin Hassett to lead the Fed next year, telling the Wall Street Journal the next Fed chair should consult with him on interest rates. The president also signaling he wants rates closer to 1% or lower, arguing the move would cut borrowing costs and support economic growth. Eddie, your expectations for all of these issues, and how would you allocate capital in the new year?
Well, one thing we started doing at the beginning of this month, because we do think the bottom from November is in, and we're going to be heading into a quarter where we're going to see real acceleration of GDP. Even the Fed has GDP north of 2.5%. We think it'll be over 3%. So when you see the rate of change of the economy growing as fast as we anticipate, while the Fed is being very accommodative, I think you're going to see this market move in a big way. And one of the most bullish things we've seen is a broadening out of this market. We've started increasing exposure to small caps. We even bought home builders at the beginning of this month, and financials have really started to catch a bid. So this is telling us that the health of the market and the economy is getting stronger, and you don't have to only own tech. Tech was obviously the story of this year. I think you'll have other areas lead in the first half of 2026. So broadening out is not only healthy, but I think it will give you additional growth versus just being concentrated in tech.
Well, it's a great point that you make, because Kevin Hassett has already told us he's expecting a very strong first half of the year. He said he would be disappointed with 3% growth in the first half. He is obviously on the final list for the potential chairman of the Fed. He and Kevin Warsh, I've spoken with both of them in the past couple of months, and here they are. Take a look and make your own choice. Watch. I want to get your take on what you're expecting for the new year, 2026, in the economy. What does that look like to you today?
Right. It's going to be an absolute blockbuster year ahead. And one of the signals you just mentioned, the jobs report, that was double the expectation, the blowout jobs report. We've got GDP now for the last 2 quarters, almost 4% on average, maybe even a little bit above. And we're going to have a little bit of a hiccup in the 4th quarter because of the silly shutdown. But then things are really lifting off. And the only thing is that we're going to see a lot of whining from left-wing critics of the president about the 4th quarter, because our estimate is that the shutdown cost more than we expected at the beginning, because it had such a huge effect on this week ahead. So many people had to cancel their Thanksgiving plans because of the Democrat shutdown, that we think the economic effect might be to cut economic growth about in half for the 4th quarter.
So you're talking about what, 1% growth in the 4th quarter? How would you assess what the...
I would say 1.5 or 2. Yeah, 1.5 or 2.
Should the Federal Reserve be cutting interest rates right now?
So in a word, yes. Maria, it's quite simple. Why is it that money and financial conditions are so loose on Wall Street and considerably tighter on Main Street? Because the Fed has the policy mix exactly wrong. It has a big balance sheet like we're in the 2008 crisis, the 2020 pandemic, and has rates that are too high. It needs to shrink the Fed balance sheet and cut interest rates. In so doing, Main Street can get a much lower cost of credit. First-time home buyers can find their way into houses, and the policy mix would be right. I don't know if I'm just saying that because I grew up 200 miles from here in a sort of place far from the bright lights in big city. But Main Street needs to get its break, and it's high time they do it, and the Fed can be part of that.
Any thoughts on which candidate markets will react to, more or less? Eddie, real quick, your thoughts on the next chairman of the Fed? Kevin Hassett or Kevin Warsh?
I think either one, the market will be fine. I prefer Warsh because of his experience during the 2008 crisis, and I think he has a great understanding of the bond market as well, too, because the 10-year is critical in regards to getting rates for Wall Street and Main Street down.
Well, you have to believe that rates go lower in 26, Kenny. Look at yields this morning. We're still stuck on 4.1% on the 10-year. We are waiting on the November jobs report tomorrow morning. That could give us some more insight. And then, of course, October retail sales out tomorrow morning as well. Economists expecting 40,000 jobs created in jobs and the unemployment rate to hold steady at 4.4%. Got the November Consumer Price Index out on Thursday, and expectations call for an increase of 0.3% month to month and 3% year over year. Kenny, your expectations?
And so that's exactly why I'm in the camp that the Fed should not be slashing and burning rates by any stretch of the imagination. I worry that we're going to go right back into, a 1979, 1980 type of economy where they lower rates prematurely, inflation takes off, and then they're going to have to force us into a situation like Paul Volcker did back in 1980, and I'm very, very concerned about that. I'm not in the camp that rates right now are restrictive. I actually didn't think they should have cut, last week, but they did. I think they need to hold this steady right here because they're playing with fire, in my opinion. I don't see this. Trump says rates should be 1%. I don't see that at all.
Real quick on 2026 investing. Do you want to stick with what's been working in 25 or broaden out, Kenny?
So you want to certainly stick with tech because we're in the very early stages of this whole AI quantum race. So getting out of tech or saying you don't want to be in tech would be ridiculous. But you do have to look broader out, right? SMIDs are going to do very well, I think, into the new year. Certainly financials will do well, like we've said before. I also like basic materials, and I like consumer staples because I think if the market gets antsy in a midterm election year, that staples are going to provide some stability.
What do you think, Eddie? Where do you want to be invested in 26?
We're grossing up risk for the first quarter, so we're going to stay and increase in small caps. We even have Bitcoin ETF that we have, as well as home builders. We're still going to have about a 30% exposure to technology, as well as consumer discretionary we're going to want to own. And then we'll see what happens at the end of the first quarter. If we have to rotate and be more defensive, we will. But when you're getting accelerated growth with liquidity increasing, it is a risk-on environment, and you want to be those that are going to be that sensitive to growth. So those are the areas we're going to stay in.
All right, we will leave it there. Gentlemen, great conversation. We so appreciate your time. Thank you so much. Eddie Ghabour, Merry Christmas. We will see you soon. Kenny, you're with us all morning long, and we appreciate that.